Good morning, ladies and gentlemen. Welcome to the PICTON Property Income Limited post-AGM presentation. Throughout this recorded presentation, attendees online will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, all questions submitted today will be reviewed, with responses published on the Investor Meet Company platform where it is appropriate to do so. I'd now like to hand you over to Chair Lena Wilson. Good morning.
Good morning and welcome everyone. Thank you very much for joining us. We've had our AGM this morning, so we're delighted to take you through this post-AGM presentation and to engage with you in the Q&A that follows that. If I could just make some introductions first of all. I'm joined this morning presenting to you will be our Chief Executive Michael Morris and our Finance Director Andrew Dewhurst. I'm delighted to say that I'm also joined by my three non-executive colleagues. We have Mark Batten, who chairs our Audit and Risk Committee and is also our Senior Independent Director, Richard Jones, who chairs our Property and Valuation Committee, and my colleague Maria Bentley, who chairs our Remuneration Committee. We're all delighted to be here and we will be answering any questions you have after the presentation. So first of all, I'd like to pass to Michael, who will take you through the presentation. And as I say, that'll be 15 minutes or so, and then we'll go to a Q&A session. Michael.
Thank you, Lena. So just very briefly, Andrew and I are going to give a brief update on PICTON, an introduction for those that are less familiar with the business. We're going to talk about the markets by way of backdrop and how that impacts the market. Andrew's going to talk about our year-end results very briefly, recognising that this is a sort of post-AGM presentation. And I'm going to talk a little bit more about what's been happening over the last quarter. We're going to give a very brief summary on some of the sustainability and ESG work we've been doing this year, and then some concluding remarks, and as Lena mentioned, an opportunity for Q&A thereafter. So just turning the page, most of you know PICTON is a UK REIT established in 2005. We now have a near £900 million commercial property portfolio. We have a long-term track record we're very proud of, outperforming MSCI, and our purpose is really about being a responsible owner of real estate, helping our occupiers succeed and being valued by all our stakeholders, obviously including shareholders. Our business overview on the next slide just drills down into a little bit more detail. So we have net assets of 670 million. Our market cap is below that, and we'll talk about that in a bit. Andrew will talk about our borrowings, very conservative at the minute. And in terms of the portfolio itself, a really diversified portfolio, diversified in terms of the number of occupiers, and diversified across sectors. Currently, we're nearly 60% in industrial warehouse logistics, 30% in offices spread across the UK, and then around 10% in retail and leisure. And the other point to just mention on that slide is the underlying sort of net yield from the portfolio is close to 4%, but there's embedded reversion upside potential of over 5%, and we'll talk about that in a little bit more detail later. So to talk about the market, well, it's been a fairly turbulent few months in the economy. There's not a day goes by where it isn't sort of made news what's happening, and that has had some impact on the property market. And I've put up here a chart showing MSCI returns, both total returns, which are the dot, but income and capital, the two components of property returns. And you can see in July we have seen a downward adjustment in property values, reflecting all of this uncertainty that's going on. Actually, though, this just brings things back to to May levels because we've seen some good growth during the start of the year. We've also been through a period of slightly lower investment volume, so pricing transparency is a little bit harder than it has been. And I'll talk about each of the sectors in turn and what's happening there. So if we look at industrial warehouse and logistics, the chart on the top right shows, notwithstanding some of these more difficult times, rents still continue to rise, occupier demand still is good, and supply is very tight. And I think that's a really important backdrop to be aware of at the minute, notwithstanding some of these other challenges. In terms of capital growth, there has been a price correction in industrial. It's happened particularly where yields are perhaps at their lowest, and with rising financing costs, etc. A slight outward adjustment in yields, and that shows up quite clearly in the July numbers in the bottom chart. But I would say that the rental growth story that we are still seeing in our portfolio is offsetting some of that movement, and our own view is this is a correction rather than something more severe, as perhaps might have been seen back in the times of global financial crisis. Looking at the office market, you can see there how much lower the rental growth has been, and indeed the capital growth over the last year. There has been a bit of a correction, but not in the same way as you've seen in the industrial sector. We'll talk about it later, the work we've been doing on ESG, but I think this is particularly important in this sector as people are wanting to be not even necessarily wanting to be, needing to be more energy efficient in a world where energy costs are rising. We're also seeing more demand in flexible space, and that's something that we are adapting to as well. In terms of investor demand, a little bit thinner, again, on the back of perhaps a weaker market, but values are broadly stable, and I think, again, very much driven at an asset level by quality of asset, quality of cash flow, requirement for capital expenditure. And again, certainly in some markets, you've got residential underpinning in terms of your values. In terms of the retail market, again, rents, we think stabilizing, and you can see that in the top chart. We all know that retail values have gone through a marked pricing correction, pre-COVID and through that whole pandemic period. For the right units, there's occupational demand. We've got very limited supply of vacant retail space in our portfolio, and we're starting to see rents rising for the right type of assets at the minute, and that's flowing through, I think, into capital values. And you can see slightly driven by retail warehousing, but nevertheless small but positive movements on the capital value side, with just a much more marked correction relative to industrial. And the way I'm looking at it is that really industrial has given back some of the very, very strong gains we saw last year, whereas the retail and office sectors, which didn't experience that growth last year, have been less impacted. And I suppose to some extent, yields in the office and retail sectors are much higher, and therefore slightly less sensitive to finance market movements. So I'm going to hand over to Andrew now to talk through some of the financial numbers.
Thank you, Michael. Starting with a recap of the figures for the year ending March 22. Our profit for the year was 147 million, which was the highest recorded profit since we launched back in 2005. Our net assets increased over the year by 24% to 657 million, with earnings per share of 27 pence. Our total return for the year based on those results was 28%, and our shareholder return, so that's the change in share price over the year, was 18.7%. We paid out dividends over the year of 18.4 million, and that was an increase of 23% on the previous year, with dividend cover healthy at 150%. Moving on to the quarterly update, just to bring things up to date. The position at June 22, our net assets were up by around 2% to 670 million at the 30th of June, and our net assets per share were up to 122.9 pence. We've maintained the dividend for the quarter at 0.875p, which equates to an annual rate of 3.5 pence. And dividend cover for the quarter was also fully covered at 103. Moving on to the next slide, we can just give a brief summary on the capital structure side. Our total debt at the end of June was 218 million, and that was a loan to value of 22% on an overall basis. 98% of our debt is fixed under long-term facilities, which mature in 2031 and 2032. Michael will talk about it later, but we acquired property during the quarter, and that was utilising the extra facility that drew down on the Canada Life facility in the previous quarter. And at the end of June, we still had 45 million undrawn under our revolving credit facility. So moving on to the operational highlights, I'll pass back to Michael.
Thank you, Andrew. This just again is for the quarter to June. The assets were revalued then. Just by way of an update, you know, the lettings, the leasing activity, the rent reviews, 6%, 12%, 14% ahead of the March ERVs. And I think that reinforces the point I was making earlier about us still seeing positive rental growth, primarily in the industrial sector. The valuation uplift was 1.9%. That's definitely lower than it has been in preceding quarters, and that reflects to some extent this repricing that I alluded to in the market. And we certainly, through the valuation process this last quarter, saw some small but nevertheless actual write-downs on a number of assets, which just sort of reflected the froth coming out of certain parts of the market. Occupancy is a little bit lower this quarter, but we did buy a property in London that had void in it, and for us it's a balance. Clearly we want to create high occupancy, but buying an asset with lower occupancy is an opportunity going forwards, and clearly there's a valuation aspect to it as well, and this comes back to income and capital growth. But that was one of the primary drivers of what we hope is just a short-term reduction in occupancy. The next slide just talks to something that we launched earlier this year called PICTON Swiss Space, and this is something that we're doing on our office assets, not every single office asset, but certainly where we've got smaller space. And this is in response to, as I mentioned earlier, in a kind of post-COVID world, businesses wanting more flexibility, more certainty, perhaps around costs than the traditional real estate leasing model offered. And this is all about flexible, fitted and inclusive space. And it's early days for us, but we're very definitely getting traction here. And as I say, rolled out where we tend to have slightly smaller floor plates and therefore more SME focused businesses who want this flexibility. which leads quite nicely on to the building that I just alluded to in West London called Charlotte Terrace, where we've bought an unbroken parade very close to Olympia, which in itself is undergoing £1 billion regeneration as we speak. This block has got retail units on ground floor, offices up above. It's actually listed. It's rebuilt in the early 90s behind the facade. The listing of this building means that it has preferential tax treatment. There's no business rates on vacant units, so that's something that we were very mindful of. Low rents, low capital value. We bought below the reinstatement value, the replacement cost, and again, a property where this more flexible leasing offering is what the market wants, and we're at very early stages in the upgrading of it, but early signs are very positive, so pleased about that. And then on the next slide, literally just announced this week, we've bought a building in Cheltenham. You can see there again retail on ground floor, so Tesco's is the key retailer at ground floor, and then we've got offices up above. Really good building next to John Lewis in the town centre, refurbished and relet basically during COVID. So in a tricky market. So we think the rents are sensible, and a really good income profile, 7 going to 9, so very attractive in this market. Good sustainability credentials. Not only has this building got B-rated EPCs, it's a building that doesn't run on natural gas; it runs on electricity. So that, from a sort of being carbon net zero ready, is attractive too. So pleased about that. Moving the page, our voids. There's two sort of income upsides within the business at the minute. A proportion comes through where rents are below market levels, and that's principally in our industrial assets, and us capturing the rental growth coming through. And the other quite significant component is through the current vacancy. I mentioned earlier we're running at 91% occupancy at the minute. And we've just put a summary of the top 5 voids here at the minute. Charlotte Terrace has obviously increased our vacancy short term, but hopefully you can see from the pictures, and there's details online, I'm sure, these are good quality buildings. We are appealing to the sort of current market at the minute, and progress, I think, is being made on all of those assets in terms of in occupier inquiries, viewings, and moving things forward. So good quality assets to be pushing that occupancy from. A couple of slides just as a slight aside on being responsible and some of the work we've been doing, particularly around sustainability. This isn't something that we've just sort of jumped on the bandwagon. This is something we've been doing for quite a long period of time within the business. We've set up a responsibility committee that oversees our progress. In the last 12 months, we've published our net zero pathway, which has got a target date of 2040, 10 years ahead of the government targets. And importantly, that's a very wide scope target, so including scope 1, 2, and 3 emissions. So we're looking at things holistically there. We've also been through a whole risk assessment of our assets and climate change, and this summer, if ever there's one to talk about, drought and some of the challenges that are coming through that are evident we're seeing in climate change. that's something that's very much been on our agenda. And green lease clauses, when we started introducing green lease clauses, we got a lot of pushback from occupiers who didn't get where we were coming from. The whole conversation has moved on now, and this all is helping us, move the portfolio. It's not going to happen overnight, but move the portfolio to a much sort of greener position. And then specifically at the properties, so this is the next slide. We sit here today, nearly 80% of the portfolio is rated EPC, A to C EPC. That's a continual asset management program of upgrading the energy efficiencies of our building. We've spoken about net zero and started to remove gas from our assets, using green electricity where appropriate, and simple things like low energy lighting, smart buildings, efficient building management systems, all are steps in the right direction. And we definitely think with this sort of rising energy costs that really has yet to bite, more and more occupiers are going to come on board and want to be involved in reducing emissions, and that's really important for that scope 3 well-being, cycle storage, shower facilities, etc. All important things that are helping us actually with leasing. This is the point of it. Actually, it's what occupiers want. And then biodiversity, not appropriate at every asset, but certainly where we can, we're doing our bit there too. We published a sustainability report probably 2.5 months ago now, but that's on our website and clearly has a lot more detail on this if you're interested. And then finally, our pathway, which I touched on, this is about reducing embodied carbon, improving energy efficiency, renewable energy at our buildings, and then we'll go to a kind of offsetting position. But the approach that we're taking, which is it's known as an energy hierarchy, is very much reducing our emissions rather than simply trying to offset. And I think that's really important, recognising where energy costs are. So really, I'm going to conclude now and try and wrap this up. I mean, I think the starting point is it is a more difficult market. Economic conditions are harder. And I've said, it's more challenging again. It feels to us like every 2 or 3 years now, there's yet another challenge that the economy has to overcome. But our own view is that property is a robust asset class. There's lots of protections within the way leases are structured, etc. And we think that the market we're going into is likely to create opportunities. Our purchase in Cheltenham, for example, at a marked discount to the original vendor expectations. It's a disciplined approach, very much asset driven rather than perhaps sector hierarchy. We think that sector returns are going to converge. So we've been through a period historically where industrial has been a very strong outperformer relative to the other sectors. Looking forwards, that gap is going to narrow markedly, and it's going to be about the underlying property fundamentals, perhaps more so than the sectors they're in. I've hopefully demonstrated that there's significant reversionary potential in the portfolio, both in our office and in industrial assets in particular. And I think asset management, the team that works with Andrew and I here, is a team that's been with us a long time, delivered strong returns, and this sort of de-risking of the portfolio in this sort of more uncertain time, I think is really important. Our debt, as Andrew mentioned, 95% fixed with a long-term maturity profile. Most of our debt matures in 31, 32 for memory. Again, not having short-term refinancing risk at the minute, I think is a real positive. And I would go back to the point that generally in the market, notwithstanding a lot of the challenges that are out there, the supply of quality real estate is actually quite limited, and it's more limited than you would think. And that balance between supply and demand, is what's supporting rents, and indeed in a number of markets we're still seeing rents grow. And I think the quality of your portfolio, the quality of the assets, will lead to tenant retention, rising occupancy, and indeed rental value growth. And I suppose finally, we do need to recognise that PICTON shares trade on a discount to NAV. We're disappointed about that, but we recognise that that's a position within the wider real estate market generally. And clearly as a board, as a business, we're trying to do everything we can, little by little, to narrow that discount, and hopefully the ongoing work we do, the asset management, will shine through and provide a little bit more clarity going forwards. So I think I'm going to wrap up there, and happy to take questions.
Michael, that's great, and Lena and Andrew as well. If I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Lena, as you can see, we have received a number of questions today, so thank you to all of those on the call for taking the time to submit their questions. If I could please just hand back to you to run through that Q&A tab, and where appropriate to do so, if you could please just read out the questions and give your response, and then I'll pick up from you at the end. Thank you.
Great, thank you very much. I can see with some of the questions coming in that Michael has already mentioned some of these areas, but very happy to go through them. And thank you already for submitting your questions. Perhaps we'll start with a question from Nick B. With a strong market and being well positioned in industrial, what is your sell criteria to recycle funds? Michael, you concluded with some of the sectoral split that you were talking about, but perhaps you could pick that up.
Yeah, I mean, we're continually kind of evaluating, buy, hold, sell across the portfolio. There's kind of an absolute return criteria and a relative. So looking where assets are positioned relative to each other, but then in terms of total returns and the market as a whole. I kind of get that the premise behind the question in terms of, well, industrial's done very well. Actually, is this now a point to consider selling? And I think that's always the case. But we still believe that taking perhaps not a short term, like a 12-month view, but perhaps longer than that, we've got a really good quality industrial portfolio, and selling it is relatively easy. Being able to buy it back is remarkably difficult. So this is just an ongoing process, and you'll have seen the acquisitions that we've made recently, to flip it back the other way, have been in kind of retail and office sectors, and that's because we think there's good value there. There's just a subtle difference between buying into a sector and selling out of it, and that really is driven by the sort of 7-8% round trip costs in selling real estate. Stamp duty is significant, but rest assured that we are looking kind of across sectors where we can recycle.
Thank you very much, Michael. And actually kind of related to that in terms of that sectoral mix, we have a question from Ryan. How do you see the office market trending, and how do you anticipate the mix of the portfolio changing over time? You did cover some of that with an eye to the office market particularly, and that flight to quality.
Yeah, so to just summarise the last 3 years, industrial has gone up, retail has gone down, and offices have gone down a little bit, broadly flat, but stayed static. So whereas the previous question was about the growth that had come from the industrial sector and capturing that, recycling perhaps maybe into offices, retail. Office market has been subdued for some time, and most businesses we speak to are working in a kind of hybrid way, and certainly it's taken quite a lot of time for companies to know what they want to do in this sort of hybrid world. And I do think demand generally is a little bit more sluggish than it was pre-pandemic, but it's all about this kind of flight to quality as people are moving and wanting to attract staff, retain talent, bring people back into the office. They want better quality space, and so that's how we look at the office market. We don't just look at a location per se. The quality of the building, the quality of the offer, and indeed the quality that could be delivered at a building is really important, because ultimately if it's priced in and the capital expenditure gets you a really good product that people want to be in, that's not a problem. But poorer located buildings that have got a lot of capex that isn't reflected in the pricing are very, very dangerous, I think, at the minute, and a bit of a value trap. So we're cautious on the office market, but for the right assets. And Cheltenham is just a really good example. We paid just over 5 million for it. The vendor spent nearly 3 million pounds refurbishing it. But as they have refurbished it, it's grade A space. It's what people want. It leased up in COVID, and it's got really strong, future-proofed ESG credentials, as I mentioned. No natural gas, good energy efficiency, and that's where the market's heading. And that's not strictly about prime or secondary. It's just about having the office space that the market wants in future. So we're cognizant of the risks, and for the right assets, we'll move forwards.
Great, thank you, Michael. And we have a question from Alex M. Are there any future regulatory changes and challenges facing the property industry with regards to ESG and sustainability? This board has spent quite a lot of time. Michael mentioned our recently published sustainability report, but we spent a lot of time as a board this year carefully considering our net zero targets and carefully considering the challenges. And just to reiterate what Michael said, we've gone for a target of 2040, but covering a very broad scope, and really looking at the minimum possible offsetting. So that's a target that we hope that we can achieve earlier if possible. But actually there are a whole number of additional challenges to when we discuss that, not solely the energy crisis that the whole world finds itself in, and as moving away as a consequence of natural gas, etc. So we have spent a lot of time on this. For us, I think there are a great deal of challenges, mostly delivered by the current economic environment, how our suppliers looking to their energy needs and their energy costs. Also, we have a new government in the UK coming in, and interesting to see both candidates backtracking a little on some of this, and in terms of how we'll deal with that. We have a ESG or sustainability champion on the board. Maria Bentley also occupies that position. So as a board, we want to make sure that we have a non-executive director actually leading some of our thoughts on that. And you don't have to come in, Maria, but would you like to come in anything from your perspective?
Well, I think I just echo what you're saying, Lena, that it has been a topic of considerable discussion, a lot of care and attention, I think, put into the plans outlined so far. And the team is very engaged, and that's partly my role, not only to be the champion on ESG within the board, but also get more closely involved with the team and the work that it's doing on an ongoing basis.
Thanks, Maria. And part of that work is actually really keeping our eye on all regulatory changes, not just relating to sustainability, but relating to technology and planning and the like, and the intersection of some of these things. So I think we will be closely keeping our eye on the new government and targets and what that means for us. But it is a matter that's occupied a great deal of our board time and attention.
Lena, that's great, and thank you very much indeed for taking the time to address all of those questions that came in from investors today. And of course, if there are any further questions that are submitted today, we'll make these available to you immediately after the presentation has ended for you to review, and then we'll publish all those responses where it's appropriate to do so on the Investor Meet Company platform. I will shortly redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the board. But perhaps before doing so, if I may just ask you for a few closing comments just to wrap up with. Thank you.
Hopefully you find everything interesting, informative. We're available. Michael can be contacted, and indeed if there's anything else afterwards that you didn't get to comment on or have a question on, please let us know. But with that, thank you very much for joining us, and we'll end there.
Lena, that's great. And Michael, and to the rest of the board as well, thank you very much indeed for updating investors today. On behalf of the management team of PICTON Property Income Limited, we would like to thank you for attending today's presentation, and good afternoon to you all.